You are listening to a special preview of the KE Report Weekend Show with your hosts, Corey Fleck and Al Corlin. This preview is brought to you by our friends at goldeagle.com. To listen to the full 2-hour weekend show, please visit www.kereport.com on Saturday morning. Welcome back. Here to wrap up the first hour of the weekend edition, I have on the line with me Joe Mazumdar, the business partner with Brent Cook over at Exploration Insights. If anybody wants a little preview of what Joe and I chatted about earlier on in the week, check out the daily editorial to kick off Wednesday, where we broke down 5 different commodities in terms of gold, silver, copper, zinc, and uranium, and Joe and Brent's outlook on these sectors, these commodities, including the underlying companies. Joe, I want to get right into it, and I want to talk about a recent presentation that you gave at the Metals Investor Forum in Vancouver. First of all, let's talk about the interest in the resource markets in terms of financings. We've been seeing a number of financings across the board. Big companies, mid-sized companies, and even the juniors are able to finance, albeit not at the high levels when we were at the peak, but this definitely is showing some interest that is coming back into the market, is it not?
Absolutely. So last year we might have seen $1 billion plus of financing in the precious metal sector. A lot of that was consumed by streamers and producers within almost the first quarter of last year. And, there were bits and bobs here and there, but really there was nothing sustainable, and a lot of the others never got any. And even some of the bigger ones were actually held up, even though they were bought deals. This year, we've had a few of those big financings as well. We've had Franco and I believe Kinross earlier this year, and, comparable to last year as well. But what we're seeing is that it's continuing. And we see the 1 millions, the 5 millions, that kind of range of equity financing, and not for producers. Now we're seeing, as you said, for the explorers. So in terms of what we're seeing, is that other people, smaller companies, illiquid, are getting financing and funding.
Joe, when we talk about these different financings that are coming in for whichever company it is, obviously the bigger companies, the large caps, are financing through some pretty well-known institutions. Where do you think a lot of these smaller, even mid-sized companies are getting their funding from?
Well, some of them do private placements or brokered placements, but I believe that they're tapping retail, something that has been almost non-existent for the last, let's say, 3, potentially 4 years, has resurrected. It's not, like you said, at the same volumes as we've seen 4 years ago. So we've seen explorers 4 years ago that could raise $50 million at a premium to where they were trading with no warrants. We're not seeing that. We're seeing warrants, and we're not seeing people getting a ridiculous amount of money, and we're not seeing them get ridiculous premiums. But what we are seeing, which is positive, is we are seeing them getting funded, and we are seeing a pickup in retail interest.
We definitely have been, which is nice. We've even seen more people commenting on our blog, and I know talking to a number of the different analysts, there are people that are paying more attention to this sector, whether they think that it's very beat up or whether that they're true believers. So that being said, I want to get more in depth into this talk that you gave at the Metals Investor Forum, talking about quality versus leverage in this sector for specific companies. Can you give us a quick little rundown of maybe the Coles notes of what your talk was?
The thing is, what we tend to do in Exploration Insights is we look for quality, because the way we think about it is quality is something that survives cycles, something that if the stock went down on that quality asset, you would buy more. You wouldn't sell it. Whereas leverage means that you've got an affinity to the commodity, saying, okay, this is going to go up higher, and if I want leverage, I want the company that makes nothing at the current gold price, but whose free cash flow potentially or the asset value will go up infinitely with a small increase in the gold price. And so the leverage play would have the underlying marginal asset, whereas when we look for quality, what we're trying to do is not necessarily just go for high grade. We're looking for high margin as opposed to high production volume, which might be the leverage play. We don't want it too complex, either geologically or technically, in terms of red flags. We need a competent management team. But on a leverage play, you might not care about the management team. You just need liquidity, and you need the company to have enough working capital to provide you enough, option time. And as you know, option valuation is about the period of the option, the strike price, and the volatility. The volatility is not an issue. We'll always get that. What we're trying to get on the quality side is a lower cost asset, whereas the leverage guy will look for something that's currently doesn't work in the current environment.
Now, with these quality plays, one could argue that a lot of these, after this last 5 years of downturn, a lot of these quality plays are fairly well known because these companies have been able to either produce at the current low commodities price and generate a return, or for some reason they have just risen to the top and investors are well aware of them. That doesn't mean that they're not a good investment, though, correct?
No, but here's the thing: is that what we've shown is like for an example, like Kaminak Gold, that got bought out, and so in terms of our portfolio from when it was purchased, or let's say the return offered to investors who bought it when the market was turning, let's say in the beginning of December, November 30th, they might have gotten over a 200% return. Whereas over the same period, when we graph this, the GDXJ would have given half that. So this is a quality asset, but it got taken on an M&A bid. So if you buy quality, and we're just talking about advanced exploration and development plays now, we're not talking about production. If you buy quality, your exit strategy for us is an M&A bid. You're not going to get that with a leverage play. Because as we shown in our presentation, is that if I change the gold price $200 per ounce for a big company like Newmont, I can add another 11 million ounces of reserve without blinking an eye. So why would I buy somebody else's marginal asset? And then add on to that the idea that, hey, there's been about $11 billion of impairments taken by the top 6 gold companies in 2015. Goldcorp was one of the bigger ones. Barrick and Yamana took anywhere from $3 to $5 billion of impairments. So those impairments are fresh in their heads when they took the gold price down from whatever, $1,400, $1,500 down to $1,100 or $1,200. They're not ripe right now in the current market environment where the gold price is still wavering around $1,250 to go back and increase and say, hey, I want more marginal ounces. I've already been on that bus and I got off of it. So I'm not going to come back right now. So the M&A bid right now is for quality. So I'm not necessarily looking for growth. What I'm looking for is return. So that different mentality means they're shopping in a different part, in a different store.
So essentially, in summary, it's all about high grade, high margin. That's a combination preferably led by a competent management team and in a friendly jurisdiction, plus the company has funds to weather any sort of short-term storm. Would you say that's accurate?
Well, if we're talking quality, what we pointed out is that if you do leverage, you want something in a safe jurisdiction because some of the leverage volume is coming from the States, which geopolitically they can be a little bit myopic. And so if you pick an asset that's marginal in a country that they won't play, it won't matter. It won't be leveraged to the gold price because it won't trade. However, if you pick a quality asset, jurisdiction should be mining friendly with transparent permitting, such that you can see people already getting permitted and stuff like that. But it doesn't necessarily have to be the United States or Canada or Australia. You can pick some places like, look, Serbia. Reservoir Minerals gets taken over in Serbia. So That's not on everybody's lips with respect to one of the better jurisdictions in the world, but there's assets in there that are operating. There's a high-grade quality asset there that they want to develop, and the company that's looking to take it over is coming from Eritrea. So Serbia to them looks a lot better. So perspective matters a lot, but they'll only apply that when they're looking for a quality asset. There's no way that they're going to go to a iffy jurisdiction for a marginal asset.
Well, Joe, I think the underlying facts here are that the market is still going to be very selective in terms of M&A type of deals. Big companies and companies with money that want to take over properties that are either in production or very close to production need high-quality ounces, and that is high-quality grade, also some lower capex costs. And it's been a continuing trend that we've seen in this market. It seems to be continuing, and when we do get these marginal assets that start to garner a buy, that simply is because of an escalating gold price and forecasts of a much higher gold price. Joe, I have to say, I always enjoy reading over the Exploration Insights newsletter. I thank you for your time. If anybody wants more information on Exploration Insights, feel free to email me directly at fleck@kereport.com. Stick around, we're going to be right back.